Imagine a world where cash no longer exists, where every transaction you make is recorded, monitored, and tracked by your central bank. Central Bank Digital Currencies, or CBDCs, are no longer a distant concept. They are an emerging reality that could redefine how Americans store, use, and protect their money. In this video, we will explore what CBDCs are, how they work, and the potential consequences for your personal finances. From the savings in your bank account to the payments you make daily, understanding this shift is critical. The landscape of money is changing, and Americans need to know how to navigate it. Central bank digital currencies are digital forms of a nation's currency, issued and regulated by the central bank. Unlike cryptocurrencies such as Bitcoin or Ethereum, CBDCs are legal tender, fully backed by the government, and integrated into the existing financial system. The United States, along with several other major economies, is actively exploring the implementation of a CBDC. The goal is to enhance payment efficiency, reduce costs, and provide faster, safer methods for transactions. However, the rise of CBDCs raises significant questions about privacy, financial control, and the future of cash. Americans, investors, and businesses must understand these developments. Today, we will dissect the economics behind CBDCs, the impact on the U.S. economy, and the practical effects on households and businesses. U.S. economy and CBDCs. The U.S. economy is currently navigating a complex landscape of post-pandemic recovery, inflation pressures, and monetary tightening. Central bank digital currencies could become a tool for the Federal Reserve to manage liquidity and monitor the money supply more efficiently. CBDCs could enable instant transactions, reducing reliance on traditional banking infrastructure. For example, payments between businesses and consumers could occur in real time without intermediaries. This could lower transaction costs and improve efficiency. At the same time, the introduction of CBDCs may influence monetary policy in unprecedented ways. The Federal Reserve could implement negative interest rates more directly, credit stimulus directly to individuals, or even program spending in specific sectors. While these tools may provide flexibility, they also raise concerns regarding centralized financial control. Inflation implications. One major concern for Americans is inflation. CBDCs could impact inflation dynamics by providing central banks with more precise tools to influence the money supply. For instance, if the Fed needs to stimulate the economy, a digital currency could allow direct crediting of funds to citizen accounts. This bypasses traditional banks and potentially accelerates economic stimulus. Conversely, CBDCs could be used to limit spending if inflation rises too quickly by applying restrictions or higher transaction costs digitally. For everyday Americans, this could mean more immediate effects of policy decisions on household budgets. Inflation could be managed more efficiently, but the trade-off may involve a loss of autonomy over how money is spent. Interest rates and monetary policy. Interest rates have been a central tool for economic management. In a CBDC environment, the Federal Reserve could implement interest rate changes directly on digital balances. This could streamline traditional mechanisms of monetary control, bypassing banks and potentially reducing the lag between policy decisions and economic impact. For investors, this may change the strategy for fixed income investments. Bonds, savings accounts, and other interest-sensitive assets could be affected by instantaneous rate adjustments, creating both risks and opportunities in portfolio management. Stock market considerations. The stock market may also respond to CBDC implementation. Faster and more direct monetary transmission could stabilize markets in some cases, but it may also introduce new volatility.
If liquidity injections can be applied directly to citizens, consumer spending could increase, benefiting retail and tech sectors. However, tighter controls could reduce speculative capital flow, impacting growth stocks. Investors should monitor how CBDCs interact with existing financial instruments and the broader economic environment. Portfolio diversification may become more important than ever before in a digitally monetized economy.
Housing markets may experience subtle but significant effects. With faster payments and potential digital tracking, mortgage payments, real estate transactions, and property management could become more efficient. However, the increased monitoring and potential programmable money could introduce challenges for property owners and buyers. Central banks could influence mortgage interest rates and lending practices directly through digital currency mechanisms, creating both opportunities and new forms of risk. The implementation of CBDCs could indirectly affect wages and employment. A more efficient payment system could reduce transaction costs for employers, potentially freeing up capital for wage increases or investment in business growth. On the other hand, automation of financial monitoring may reduce demand for certain financial services jobs, such as payment processing, bookkeeping, or banking roles. Workers and small business owners should prepare for shifts in the labor market linked to digital currency adoption. For families, investors, retirees, and small businesses, CBDCs present both opportunities and risks. Families. Faster payments and potential direct stimulus could improve household cash flow, but privacy concerns may arise. Investors. Portfolio strategies must account for instantaneous monetary policy and digital money effects on interest rates, inflation, and liquidity. Home buyers. Mortgage processes could become more transparent and efficient, yet central bank programming could affect lending terms. Retirees. Fixed income reliance may require reevaluation, as digital interest policy could change expected yields. Small businesses. Payment efficiency may improve, but transaction monitoring and programmable currency rules could add compliance challenges. While CBDCs promise efficiency and modernization, several risks must be considered. Privacy. Every digital transaction could be recorded, creating transparency but potentially reducing personal financial privacy. Centralized control. The Federal Reserve could theoretically influence individual spending directly. Cybersecurity. Digital currencies are vulnerable to hacking and digital fraud, creating potential systemic risk. Market adaptation. Traditional banks and financial institutions will need to adapt, potentially creating transitional volatility. Americans must understand that CBDCs are not hypothetical. Planning, monitoring, and understanding financial implications will be crucial for wealth preservation. Central bank digital currencies are a major evolution in money, potentially reshaping payments, monetary policy, and financial control in the United States. For American families, investors, home buyers, and small business owners, understanding CBDCs is no longer optional. Awareness, preparation, and careful financial planning will be essential to navigate this digital future successfully. While CBDCs offer efficiency and modernization, they also introduce new considerations for privacy, control, and wealth management. The future of money is digital, and Americans who understand it today will be better positioned to tomorrow.